Bond yields continued lower today after a brief uptick this morning back into the Fed's target range. The 10-year note yield went back south of 2.25 in a late day buying frenzy as equities gave up their gains as well. So it looks like the bond market right now, which has pressed those low yields 2 days in a row, will continue to do so. There continues to be demand, there continues to be lack of supply. And it seems to me no matter what we get on the tapes as far as economic data domestically, no matter what we hear, there seems to be this overhang on the market that risk with China is greater, risk with Europe is greater, and any kind of risk you want to paint in Washington continues to overhang the market, and that will continue to push bond yields lower, as it has going back really since March. We've seen yields kind of tumble here. Against what we've seen in the stock market. Rallies, comes back. We've seen a straight shoot down in bond yields. And market volatility, yeah, it's still in the year-to-date high after pressing those low yields 2 days in a row. And why wouldn't it be? You continue to see higher risks being priced into the market. Now you're starting to see perhaps a position shift. If we hadn't already seen one, we may be seeing part two of that as we start to get those yields lower and lower. If we break below 220, I think there's going to be another knockout, and that could create even more buying needs. And right now that seems to be a level that is sort of seller friendly, but I think they also start selling 230 yield was seller friendly, and selling 2.25 yield was seller friendly, and neither have been. So implied volatility on the rise, while as I mentioned yesterday, the VIX index continues to kind of be trade subdued, despite the fact that we get lower highs on each of these moves in the equity markets when we see pullbacks in the equity markets. But bond vol's been running high over the last, say, 4 or 5 sessions, and will continue to do so as we test these low yields. And lastly, what can the Fed do? Well, Fed Vice Chair Clarita came out today and said, well, the Fed's going to remain patient, sort of echoing what his colleagues have been saying, as well as Chairman Powell has been saying for quite some time. Well, at some point, the Fed's going to have to stop being patient and kind of do something, whether it's tweaking their balance sheet to increase the supply and maybe nudge yields higher that way, or are they going to follow the market's lead and actually cut rates? Because if you look at Fed Fund futures, they're showing 2%, implying a 2% effective rate by year end and about a 165 by the end of next year. So I think at this point, the Fed's going to have to do something. They may wait until after the June FOMC and subsequently following July testimony to Congress by Chairman Powell to kind of set the tone for that. But ultimately, right now, the market's giving one clear indication versus what the Fed is saying, and the two both can't be right, but eventually we do have some time on our hands. I think the second half of the year becomes very, very important for growth, very, very important for the geopolitical mess that is China-U.S. trade, and whether you look over in Europe, what's happening there with their political and economic mess that they've created, I think, and as well as trade with the U.S., I think all of it is up in the air. And don't forget that President Draghi will be leaving office in October, so we're going to get a new head of the ECB before the end of the year. So a lot of uncertainty going on, and I think right now the bond market's telling you more so than the stock market to watch out, cover up, and wait and see what happens. The risk-averse traders are now stepping up, and we're seeing those risk takers maybe take a back seat to that. Ultimately, I think bond yields still have some ways to go to the downside. 220 would be the next stop. If we do see a move higher, I'm looking at possibly 230 being the first stopping point and seeing buyers step in there. But scarcity and demand right now are what's pushing the bond market, and that means we do have some more ways to go, upside in price, downside in yield.